Hey YouTube, this is Zach with Achilles Financial, and today I'm going to be talking about how the Federal Reserve Board is going to begin winding down their secondary market corporate credit facility, and this is actually a really big deal. However, before I start talking about this, I do want to recognize that this is super important, but I also want to highlight that there was a lot going on in the market today, and if you're watching this in the future, today is when we saw just a massive run from AMC as well as a number of other meme stocks in the form of GameStop, Palantir, and Bed Bath & Beyond, or even Beyond Meat. So there's been a lot of movement in the market. A lot of that is happening because there is a lot of excess liquidity in the markets, meaning there is a lot of available money. And everything that we see right now is not simply shorts getting squeezed, but rather there is a lot of money going into these stocks, which is running them up. Some of the concerns I have with that going forward is going to be the issuance of additional shares, as well as a number of people who are going to at some point begin profit taking. So just want to highlight that there is a lot of liquidity, and what we are looking at here on the screen with the secondary market corporate credit facility is a lot of liquidity that is going to be taken away. So the first thing we need to ask, especially if you are new to the channel or you are new to essentially the Federal Reserve, is what is the secondary market corporate credit facility, which is brand new as of last year. Essentially what this is a bond purchase agreement that the Federal Reserve started last year to essentially provide businesses with liquidity, with cash, by buying their corporate bonds. This is something that has never been done until last year. And so essentially what they were doing is they were buying bonds for pretty large, substantial companies in the form of corporate debt. Some of the funds that were purchased were AT&T, Verizon, Toyota, Apple, Comcast, Microsoft, or BMW. The reason why we highlight this is because this is millions and millions of dollars that were going into these corporate bonds that are essentially going to be sold off over time. So if they were sold in a very rapid sprint, then we'd see all of that money get poured essentially back into the market, which we'd have to be asking, where does this go? One of the things that this is going to be kind of the beginning of is, will we see quantitative easing, or will we see essentially the pullback of some of the fiscal stimulus that we've seen over the past 12 months? So let's take a look at what that fiscal stimulus looks like. Just to showcase some of the sheer size of these assets that the Federal Reserve has taken on, what I have here on the screen is the Federal Reserve total assets. And you can see that throughout the 2014 to 2018 time period, they really were hovering around $4.5 trillion. I want to re-highlight that this is in trillions of dollars, which is pretty unfathomable numbers. Even more crazy than that is that during the pandemic, it actually spiked all the way up to where we're at today, which is nearly $8 trillion. And when these numbers get updated for this week, it is very well possible they may already be above $8 trillion because they've been purchasing $120 billion worth of mortgage-backed securities on a weekly basis, which is absolutely insane. So the reason why we highlight this is because this means that there is a lot of excess money in the markets at the same time that we've seen interest rates at an all-time low. So as we begin to see this start pulling back, as we begin to hear talks of tapering, which means the slowing down of these asset purchases, that means that we're not going to have this huge pile of money that is constantly pushing asset prices up and up and up, which you can see associated with overall the Federal Reserve and the stock market, how these purchases continue to push not just these total assets up and up and up, which there is a very strong correlation between this and the overall stock market, whether you're looking at VOO or SPY. So the question that we need to ask here is, if we begin to see this purchases slow, or if we begin to see this decline that we see right here, what impact is that going to have on the stock market, and what is it going to have on some of these in particular stocks that have absolutely crazy amounts of liquidity going for them right now? Are we going to see that in the overall ETF market, bond market, and when we're watching this? So that's what I'm going to be watching for, is as they begin to stop having these purchases, as they release these numbers from the balance sheet, does that lead to tapering? Does that lead to a rise in interest rates? And I don't anticipate seeing a rise in interest rates this calendar year, but if we talk about rising them for next year, that's obviously going to have a negative impact on a lot of the high-flying tech stocks, and it may do well for some of our banking stocks. So that's what we're going to be looking at, and this is kind of a overall high-level view of what that will mean, but overall just recognize that the Federal Reserve is going to start releasing assets from their balance sheet, and hopefully they'll stop purchasing more in the coming future. So if you find this content helpful, please leave a like and subscribe, and let me know in the comments below how you did trading today, or if you have any questions over this material. Also, feel free to join the Discord in the description down below. Thanks. Talk to you later.